Hello and welcome to this discussion with iShares, focusing on Bond ETFs, which we've called All Systems Go. I'm Mark Dunn, your host for this discussion, and my day job is editing an investment magazine called Portfolio Institutional. Now, we've already spoken with iShares about fixed income ETFs and the modernisation of the bond markets, and this discussion retains that theme of innovation, but looking specifically at how bond ETFs themselves have evolved. And I'm glad to say that I'm joined by a man who knows all about this topic. Hi, Brett.
Hello, Mark.
Could you just give us a few words of introduction, please?
Sure. Once again, my name is Brett Olson. I am responsible for the fixed income ETF business here at BlackRock in EMEA.
Thank you very much. And if you could actually start this discussion by just looking back for a moment. I mean, it's been 20 years after launching the first Bond ETF. I mean, how has this innovative tool revolutionized fixed income investing?
All right, well, Mark, this is going to definitely date me, but when I started out in fixed income on the sales side of the equation, I hand wrote my ticket, I timestamped them, the trades were done over the phone, and they were picked up by a runner. And this was in the late 90s, early 90s. Things have definitely evolved here, right, in terms of how people are trading bonds. But really, the advent of bond ETFs has revolutionized the way people invest in fixed income. And if we go back those 20 years or so, it would have been really difficult to even imagine instantaneously buying or selling hundreds or thousands of bonds in a single trade. Investors basically had to phone or message, but mainly it was phoning, telephoning at the time. People weren't using Bloomberg that much for even the messaging of trades, to get quotes and to try to negotiate terms, and then hoping that one of the sell side parties would have inventory at hand to be actually facilitate a trade. So it was very cumbersome, very opaque. There was very limited information in terms of the transparency of where things were actually pricing. If we think about 2002, that was when iShares launched their first fixed income ETFs, which really connected this fragmented fixed income market with more transparent and liquid on-exchange trading. And we would argue that over these past 20 years, bond ETFs have become fundamental to fixed income investing. ETFs, they've been catalysts that have allowed investors to really easily buy a whole portfolio of bonds at the click of a button. And with a growth rate of 23% annually, bond ETFs have grown significantly over this time.
How would you describe the growth of bond ETF adoption?
Sure. The global bond ETF industry is growing even faster than we expected. The pandemic era actually accelerated bond ETF adoption in ways that are self-reinforcing, and we believe actually enduring. It took 17 years for the bond ETF industry AUM to reach $1 trillion in size. That was 3 years ago, and as the industry approached this milestone, we forecasted that the global bond ETF industry would double by the end of 2024 to $2 trillion. We believe actually that we are poised to reach this in 2023, despite the currently challenging macroeconomic conditions that we're seeing. There's been tremendous runway growth for fixed income ETFs, and we believe that the adoption of bond ETFs is set to accelerate as all types of investors, from individuals to wealth managers to asset owners to asset managers, use bond ETFs in more and different ways. And for this reason, we actually upgraded our outlook and projected that the global bond ETF AUM will reach $5 trillion by the end of 2030.
What's fueling this accelerated adoption of bond ETFs?
So we see 4 key trends really driving or fueling the accelerated adoption of bond ETFs. Number 1, advanced portfolio construction. So more investors are blending bond ETFs with active strategies that seek to meet investment objectives and avoid unwanted risks. So they're thinking more holistically about the outcomes they're looking to achieve. What are the building blocks they can use to actually achieve those outcomes in the most cost-effective way? Secondly, they're tools for seeking active returns. So sophisticated investors, including fundamental active fixed income asset managers, are turning to bond ETFs for transparency, access, liquidity, and portfolio efficiency. Thirdly, increasingly precise sources of potential returns. New bond ETFs are providing more precise fixed income exposures that allow investors to really build increasingly customizable portfolios and capture opportunities. And then lastly, they're catalysts for modernizing bond markets. Bond ETFs are reshaping fixed income market structure by helping to drive bond market electronification and automated trading.
Gotcha. And institutional investors are now among the fastest growing users of bond ETFs. I mean, what's driven that growth?
So the world's largest and most influential institutional investors are increasingly using bond ETFs based on the resilience and the liquidity the products convincingly demonstrated in the early days of the pandemic, importantly. According to a recent survey, institutional adoption is becoming broader and deeper. Data shows that 65% of institutions globally have allocated more than 30% of their portfolios to bond ETFs. We believe that asset managers and asset owners, such as pension funds, insurance companies, as well as central banks, are turning to bond ETFs for 4 reasons. Number one, transparency in terms of holdings and pricing, which remains in stark contrast to the underlying OTC bond market. Secondly, historically durable and consistent liquidity as compared with individual bonds, particularly in stress markets. We actually see the trading volumes of fixed income ETFs increase during stressed markets, and we've also seen trading volumes since the pandemic continue to increase from an ADV perspective. Thirdly, efficiency. Since bond ETFs allow for instantaneous and cost-efficient exposure to hundreds or thousands of individual bonds in a single trade on exchange. This attribute has been recognized by central banks, for example, as they look to rapidly scale up or down holdings. And then lastly, increasingly granular access to a variety of fixed income exposures across credit, quality, duration, but also potentially with sustainable outcomes or FX hedged share classes.
And finally, we come to the question I'm most excited about. What's next?
So from our perspective, the future really does look bright for the growth of bond ETFs. We've talked about earlier in this conversation the expectation that the industry will grow to $5 trillion in AUM by 2030. Bond ETFs, what they've done is they've really democratized investing in bonds for all investors. They allow all investors to be nimble and navigate bond markets. In fact, we think that the current challenges associated with high inflation and rising interest rates, as well as limited liquidity in single bonds, will continue to attract even more first-time ETF investors and actually encourage existing investors to find new ways to use these versatile investment tools. We believe that evolved portfolios will increasingly feature bond ETFs as essential elements for calibrating risks and opportunities while simultaneously increasing liquidity and lowering costs. And what's more, we believe that investors will continue to increase adoption of this powerful technology, and bond ETF innovation will bring to market more precise tools for portfolio construction and risk management. Finally, we truly believe that bond ETFs will continue to catalyze advances in the fixed income market structure, i.e. the modernization of bond markets, and will become further integrated into an increasingly modern electronic fixed income marketplace.
That was fascinating. Thank you, Brett. It looks like bond ETFs are set to be around for years to come. And who knows, maybe we should catch up in about 20 years' time to find out how it's all gone.
Perfect. Thanks a lot.
Thank you for sharing your time and your insights with us. Thank you. Goodbye.
Thanks.